my book for this?
Everybody on mute.
Good afternoon. This is
Good afternoon.
Good afternoon. This is Nolan Sampson, the Director of Business Development for the Halderman Companies. I'd like to welcome you to the 2021 Lafayette Ag Outlook Seminar. Today, I will be fielding questions for those in the audience that hear something they'd like to know a little bit more about. Go ahead and send those in the chat, and then I will direct those who needs to get the question. Today we've got Howard Halderman, who will be discussing land values and ag update. Gary Chapman from Bose McKinney and Evans on wind and solar leases and 1031 exchange, followed by Cody Galt and Savannah Steinke with Farm Credit, and they will be discussing risk management strategies. At this time, I'm going to ask the Halderman reps to unmute and introduce themselves.
I'm Gary Bolander.
Afternoon, Sam Clark here.
Hi, this is John Beckman in the Audubon office.
Yes. Good afternoon, Jim Clark in Frankfurt.
All right, and if the Farm Credit crew would like to unmute and introduce themselves as well.
Steve Nair, get to Williamsport office.
Terry Shoemaker from the Williamsport office.
Steve Widges, Senior Vice President, lending for Indiana.
Hi, Howard. Natasha Cox, Regional Vice President here in West Central Indiana.
Hi, everybody. Cody Galt, Regional Vice President, Crop Insurance, Greensburg, Indiana.
Hello, Savannah Steinke, and I am a crop insurance specialist in the Rensselaer, Williamsport, and Lafayette offices.
Great, I think that's everybody with the Farm Credit crew. Sorry if I interrupted somebody. And then I think we have Gary Chapman on with Bose McKinney. Are you on, Gary? Well, we'll go ahead and get things started with Howard. He's going to give our ag update and then followed by Gary. So Howard, if you want to take it away.
Good afternoon, everyone. Welcome this afternoon. Thank you for your attendance and your interest in this very popular subject, which is farmland. And we have the opportunity on a daily basis to interact with landowners across multiple states. The Farm Credit team also gets that same opportunity, and it's always a lot of fun to talk about one of our natural resources in this country, and obviously some very changing dynamics. Here we are 1 week or so after the inauguration. So we're just thankful you joined us and look forward to a great seminar today. I do want to say hi to Natasha. We have really enjoyed our partnership with Farm Credit over the last few years. Normally, we would love to be live with you from the courtyard by Marriott down on the State Road 26 in Lafayette. But until we all get vaccinated and or herd immunity, we will continue to move forward with these Zoom kind of meetings. And I think Nolan mentioned, we will make the slides available to whomever. I basically can email you a PDF. So if you want to email us afterwards, you can send that to us and we can get you the whole set of slides. In addition, if you would like a recording of this, we'd be glad to email that out as well if you've got somebody that was unable to join us today. So with that, I think most people know the Halderman companies. And There we go. So I'm not going to spend a lot of time here. We are 91 years young. We serve landowners of all kinds, mostly individual landowners, but we do a lot of work for municipalities, bank trust departments, and on down the line corporations. And you've probably seen this slide, do property management, do real estate sales, and we do farm appraisals. I'll stop here briefly. One of the interesting notes, you talk about the impacts of COVID. Farm Credit does a lot of appraisals. They have an in-house appraisal team. They do outstanding work. They're a key member of our national organization, the American Society of Farm Managers and Rural Appraisers. And we also have a number of certified general appraisers on our team. And this year was a record year for us in terms of appraisals. So it's just kind of interesting, one of those market dynamics COVID created for us just due to lower interest rates, people refinancing, maybe people doing some purchases. And so it really generated a lot of new business in that regard. Likewise, you might say, well, what other impacts were there of COVID, Howard? And one of the impacts on real estate sales is how we went about selling farms. And you might imagine that in late March, we had, I think, 10 auctions scheduled for April. And what do you do about those? There were 8 that were scheduled for live events, 2 were online only. We immediately converted all to online sales. We've been doing online bidding for a number of years, converted them all to online auctions. They all did very well. And 8 out of the 10 sold. The 2 that did not just simply didn't achieve the seller's goal that day. So we've subsequently sold one of those properties as a result of extended negotiations. Point being, we converted very quickly, had to pivot on a dime, still got the client's goals and objectives met. But then what happened is nothing sold. May, June, and half of July. It just went really quiet. So you talk about an impact of COVID. One of the impacts in the farmland space is that the market has got very tight then. Now that's planting season, not a lot usually happens, but one of the ongoing things that we've noticed is that the number of farms available for sale remains below normal. There was a kind of an influx, more sales back in October, November, post-harvest, traditional time period for farm sales. But if you look around now, and I read a newsletter from a broker over in Illinois this morning, and he was commenting that in his 40-year career, he's never seen this few number of farms for sale. A week ago, I talked to one of the largest brokers in the state of Iowa. His comment was the same. So it's not just Eastern Corn Belt, but we're seeing all across the Corn Belt, people are just hanging on to a very valuable asset, and that's farmland. So with that, we'll continue to move forward. Average tenure of our staff is 20 years or greater than 20 years in some instances. I might be greater, Nolan might be less than, you guys can guess. But we basically bring a team to you that has a lot of knowledge in your area and a lot of knowledge of farmland, what the values have been, history, and all those sorts of things. So that can be pretty valuable to you. No different than your farm credit team brings you as well, or Gary Chapman and his long-term knowledge of ag law here in the state of Indiana. So with that, farmland, the values are certainly strengthening. And I think you probably have read some reports. In fact, I was looking in Farm World today, the issue that just arrived this week, and there was an article on farmland values moving stronger. And that is kind of the trend that we're going to talk about today. But we'll start with that first dynamic. I talked about few farms on the marketplace. And one of the reasons there haven't been a lot is there's no outside driver of farmland sales. Tax law change, farm bill that might have some dynamic to it that would cause people to sell, a very poor outlook on the future, or back in the 1980s, too many highly leveraged farms. We haven't had any of that the last 8 years. And so as we look forward, you might think, well, okay, Howard, what could change? What could be an outside driver that might change that perspective? And I'll throw one out there that you can think about the next few months and watch what happens in Washington. But President Biden has talked about increasing the capital gains tax. Maybe it goes from 20% to 40%. That's a number I read this morning in an article. If that were to happen, do you think there might be some people who, maybe I would sell the farm, that all of a sudden say, yes, I definitely want to make that sale decision now And I want to move forward quickly before Congress enacts that higher capital gains tax. So that would be an example of an outside driver that could spur on some sales for some brief period of time. Now, I would tend to agree with Rick Brock, who wrote about this in the Brock report, that after that capital gains tax, if in fact that were to happen and doubled, that probably would be a damper on farmland sales as people would look at the competing returns from other investments. So we just haven't seen very many, and there are none right now, but that's one that you might keep your eyes on. So the number of sales remains low, especially for large tracts. You know, I look back at our sales in November and we did quite a few, but they tended to be 100 acres, 200 acres at the most, 80 acres. And so they were generally small. So the large tracts have not been very common the last few months. Cropland values, as I said, moving up currently. You know, how long, how much? That's a real question this year. But the funny thing is, for the last 5 years, we have been just in this sideways channel. And if you were at this seminar last year, you would have seen my slides depicting that. And I'll show some of those again today with then what happened in 2020. Now, recreational timber and rural residential values. You might recall that I've always said those markets move with the general economy. Well, what happened with COVID? You know, the general economy crashed for a couple of months, but low interest rates and the motivation for some people to move from urban areas to more rural areas actually was very supportive of rural residential values, timber values, and the like. So we saw those values continue to move higher this year. Now, here's a start with the Chicago Fed. We'll start large and then we'll get more microscopic, so to speak. But the 7th district are the states you see there on the right. And these are all ag bankers, FDIC banks that contribute to this survey. And you can see that in Indiana, that blue line, October to October, farmland values in their estimate went up 6%. This includes that entire COVID time period. Now, I'm not suggesting we're over COVID, but that big drop in the stock market, this includes that time period. Now, Illinois was up 1 or 2%, and Iowa up 1%. The Federal Reserve District as a whole was up 2%. So again, land value strengthening over the last year. And I checked just yesterday to see if I had the data for you on the most recent report, and that won't probably come out until early February. Now, this is the Purdue survey, so we're getting a little tighter in. We're looking at Indiana land values only. And if you look at this slide, you can see the peak back in 2013 and the decline. We've talked about this before if you joined us. But notice the trend the last 5 years. We've been very flat, but all land qualities moved up in value in the June survey in 2020. I think that's interesting. June of 2020, that survey comes out in early June. We were in the throes of just starting to open back up, but then you had a lot of the chaos in some of the large cities that was going on there over the Memorial Day holiday. So all of that is in the mix, all of that's in play, and yet farmland appraisers, farm managers, brokers, and ag lenders in the state of Indiana felt like farmland values were moving stronger. So I think that's very telling as to the strength of a farm asset and what it might offer a landowner. Now, we've talked about this before as well, and this is a way we evaluate our sales. So we look at a farm sale, this is 2013, for example, and we will take the sale price of the cropland. So sometimes we have to abstract that out, but let's say that's $8,000 an acre, and we divide it by the productivity index. So the WAPI, weighted average productivity index of the soils that exist on that farm. And basically you can go online, you can map the field of the farm you're interested in, and it'll generate for you an average productivity index. Now, that might be anywhere from 100 to 180 here in the state of Indiana. That's corn bushels per acre productivity index. The 170 to 180 range, that's actually going to produce well over 200 bushel corn year in and year out. So it's not really representative of actual yield, but is a way we can compare one farm to another. And so back in 2013, when we looked at all of our sales, you can see a lot of variability. You'll see that in every year that I'm going to show you. But the average, the red line, is really the one to look at. And if you look at that red line, it hung right around $60, $62 throughout the entire year. That's the all-time high in farmland values. Now we go to 2014 and we start at that above $60 level, but with falling commodity prices, you start to see the trend line downward at that point in time. They're into the 50s. And then as we get into 2015, the reverted back above $60 there early on in the year. And that's one of those interesting things I've always noticed about farmland. When you turn the calendar to a new year, many times people have a renewed optimism. It's going to be a new year, new yields, better prices. That's what farmers, they tend to be optimists by nature. And so sometimes we start the year over at a higher value. And that's what happened back there in 2015. But then the reality, lower commodity prices hit. And you can see that we ended the year at about $49 per bushel of productivity index. That was the big decline. Now, I said the last 5 years have been very static. And if you look at the red line through these four slides or so, there's 2016 right at $49, 2017 anywhere from 48 up to 52, 2018 $49 again, looks much like 2016 except for the variation. Then we get into 2019 and we start pretty weak. But as we got toward the end of the year, farmland values started to move up and things were looking a little more optimistic, right? And then you turn the calendar into 2020. And if you recall, probably seems like 10 years ago to some of us, does to me anyway. But if you recall back to the beginning of 2020, we were looking at phase one of the Chinese trade deal. That was a big revelation. And there was a lot of optimism and higher commodity prices, not as high as now, but much higher for the beginning of the year. So as we started 2020, we started at that higher value. Now, you see where it quickly started to fall off, and we fell in that first quarter into the 50 range. But then as we went throughout 2020, the trend line just steadily moved ahead. And we finished the year on a pretty positive note, upwards of $54 a whopping point. So that is very specific. Those are sales we did. We know the actual results. It's not a survey. It's not an opinion. Those are actual facts. So this is the overall trend. And if you looked at this a year ago, it's a subtle difference with this year. And this year we start at 48, 49 on the far left, and that red line actually ends up above 50 due to the rise over the last 4 quarters or so. Here's another way to look at it with a bar chart. And again, you can see the values per bushel on the left, the years on the bottom, and the last 4 or 5 years being pretty flat year over year. Now I threw this in. I've only got one of these slides because I thought it might be valuable to think about sales that we've done in the last few months. And so we'll start with back in November. I just want you to look at the WAPI scores here in the middle of the page. And outside of this St. Joe County sale, which what that was earlier this week, that sold extremely well. But let's just put it this way. One of the 2 tracks is going to be possibly planted all the trees. That gives you some kind of idea about the productivity. But look at these. They're all $50 or above, and 3 of them are above $60 a whopping point. And this goes back into November. So my point is that land values have been strengthening for some period of time in spite of COVID. And I think people look at farmland as an inflation hedge, right? It historically has been that. Commodity prices were improving throughout this whole time period. They'd already started to move up back in August. And I think people looked at it and said, I'd rather have my money in farmland than I would in other assets. So that's kind of a trend. These are private as well as auctions. So it's not all auctions. We do have a Halderman app, a little promo from us. If you want to download that on your phone, you can do it either on either platform. And both Google and Apple have approved that, and you can find out upcoming sales, sales results, and access data about those properties all from an app if you wish. So I did a survey back in September. Now, some of this data is a little dated because things move fast. Not usually do they move fast, but they certainly have in the last 5 months. So we did this survey in September of all of our staff. And I said, over the last year, September of 19 to September of 20, what has been the change in these classes of types of property out in the rural countryside. And you can see that our group felt like, some felt like best cropland went up, some thought it went down 10%. Average cropland similar with maybe a little more bias to the bearish side. So pretty flat markets for September. Woodlands, rural building sites, rural residences were all up and stronger. Again, low interest rates really helped that, combined with that movement from urban areas. Livestock facilities a little weaker. And those of you that are in the livestock arena, dairy, swine, those have been some tougher markets here more recently. Dominant purchasers in the market. Now this is updated through the end of the year, and these are our actual sales. So who bought Halderman Farms that we sold? And 60% remain farmers, 40% farmland investors. That's been a trend, as you can see, going way back. The farmer tends to be the predominant buyer, at least over half, except for 2011. So that's a consistent theme, although a little more farmer investor interest in 2020. Maybe not a surprise because of the better outlook for rents, farm incomes, and all of that due to more demand globally. So number of sales compared to previous years, this is just an opinion. I asked them, what do you think? What have you seen in your area? And 75% of them said, yeah, fewer sales than a year ago. Dominant purchasers in the land market. Now this is the entire market. This isn't just our sales. So when you look, Nolan, for example, you're in Northwest Indiana. So in your marketplace, did you think farmer buyers were, what percentage of the time were they the dominant purchaser? And 70% said farmer. So a little higher than what our actual results show, but pretty common. And I think if you look at surveys from Illinois and Iowa, you would see a very similar number to this. So we do have investors. We do have some institutional investors that buy farms from us, but it's very seldom. Generally speaking, we're selling to people just like you down the street, or an investor that lives in Lafayette and wants to own farmland somewhere in that area. So that works pretty well historically as a measurement as to who the buyers are of farmland. Now I'm switching over to the ag barometer. We've talked about this before. And if you recall, look at this overall chart. It's a little different than what I've shown. Usually this is a narrative, which doesn't really show it well, but this graph does. When it started back in 15, it was around that 100. This is a 0 to 200 index. 100 is, I feel, average about the agricultural outlook. And it's a touchy-feely thing. And then you saw the election. Mr. Trump gets elected in late 16, and it jumps up around 125, and it stayed there throughout almost his entire term until that big drop back in April, May, where COVID hit, and the ag barometer really cratered at that point. Not a surprise. We saw pretty low commodity prices, negative prices on oil. I mean, it was a pretty bleak time period throughout that couple of months. And then things start to improve. We get the crop planted. It starts to look decent. Crop prices start to increase. Oh, by the way, government program payments, not program payments, but actually the support payments that were paid for COVID relief, in addition to the market facilitation payments, start rolling out. And you put all of that together, and we ended up the year at a pretty high level, highest ever, at 160 plus on the index. And so a pretty good feeling out there in agriculture today about the future of that industry. So I'm going to switch gears. We're going to talk a little bit about farm debt and where we stand with that. We've been talking about this the last few years. So here's an update through 2020. And inflation adjusted, real debt, you look, we are very similar to 1980 in total billions of dollars. So all in all, that would, if it was just this number, that would be concerning because we remember what happened in the 1980s. Now, real estate debt is actually more than the non-real estate debt. So that is different, less debt on operating lines and machinery. But this is just one piece of the debt equation, because let's look at the interest rates. So interest rates back in the 1980s, many of those loans back then were variable rate, and many of them spiked to well above 15% interest rates. Interest rates today are historically low for farm mortgages. And so that makes a big difference in this graph. The blue line is what the farm sector debt is, and you can see the peak in 80 and then the peak now, very similar numbers, again, inflation adjusted. but look at the interest expense. This is the cost of borrowing that money, the check you're writing to the bank that includes principal plus interest. And this is important to the federal government as well for all the debt that they've incurred. Low interest is really helping make this a different debt scenario than what it was the last time. So as a result, we've had land values stay very steady, right? And because they've stayed steady with debt increasing slightly, your debt to equity and debt to asset ratio have not changed a ton. They've moved up, certainly from the peak back there in 2013, which means the lowest debt to equity and debt to asset ratio. They have been increasing because debt's been going up and land values have come down a little bit. But they're still well below numbers that we saw back in the 1980s. So that's a positive. The other is debt to income. We've looked at this chart in the past as well. And for those of you that haven't seen it, when it goes above 5, so debt divided by income, when that goes above a 5 ratio, it's a warning sign. Hey, you know, things are getting sticky out there in agriculture and we could start to see some financial trouble. And if you go back to 1976, 1977, we went above 5, and that was kind of a harbinger of things to come. And as we got into the 1980s, then that number really escalated. Well, that happened for us back in, 2016? We went above 5 for the first time in many, many years. But we quickly retreated from that. And thankfully so, now we're at 4.2. It's below a 5. And at this point, that trend line is down the last 5 years. And that's a real positive. That's due to, in many cases, that government support payment that we've been receiving. But higher commodity prices last year and this year will be helping that as well. So here is the share of farm real estate loans that are delinquent. And first of all, I want you to look at the scale on the left. We're only talking about 2.3% of all loans. So it's a pretty low number. And then historically, and this goes back to the late 80s, where the tail starts and then kind of swoops down. But look at that, you know, we had the recession back in 08, 09. It kind of spiked up toward 3.5% of the loans, but then quickly retreated with the golden era in agriculture. And now we've gotten back to the historical average. So that's not scary. Now, a share of farm non-real estate loans that are delinquent, and that's a very similar trend. And again, only 2.2% or so of non-real estate loans are even delinquent today. So while increasing, so that's a concern, not worrisome because we're not above the long-term average. Now, here's the total volume of delinquent loans. And you can see during the recession that certainly the volume was up and we're back at that level. But again, it's a pretty small overall number and a small percentage of all loans. Now, here is the one that I've talked about for a number of years as the concerning ratio, and that's working capital. That's cash. That's your ability to pay cash for something or pay debt today. And that number's been eroding for a number of years. It peaked back there in 2012, and then we've seen it decline for the last few years. 2020 into the 12%. I think this ratio was done earlier in the fall. I bet that number will end up being higher when it's all said and done. And 2021, we'll start to see that working capital maybe work a little bit back higher because we've generated some additional income this year. And then here's the real working capital. So taking inflation out of the equation, and this just is, just very similar to bearish in the sense that we had a lot more cash back there in the golden era of agriculture than what we do today. Bankruptcies, we've talked about this before. What the numbers were that came out after our meeting last year. 2018, we had about 500 Chapter 12 filings across the United States, not Indiana, across the US. Back in 08, there were only 250, so that's double. I got the headlines at the Wall Street Journal saying, oh, farm bankruptcies are double what they were in 08. 08 was not a bad year, folks. And so when you're double a reasonably good year, that may not be that all big a number. And when you compare it to 1987, there at the bottom of the slide, it's not even 10% of that. So the March 19 numbers, or March 20, I'm sorry, March to March, were 627. So it's a 23% increase over the 500 the year before, but still barely over 10% of what we experienced in the late 1980s. So increasing, but not overly concerning. So that's enough on debt. I don't want to spend a lot of time there. Not opposed to using debt to buy land, especially at interest rates like you can achieve today. Something you need to look at if you're looking at buying a farm. So where do values go from here? Now, we've talked about this before. It depends on these three things: farm incomes, interest rates, and supply. Now, we talked about the incomes from that golden era, generated a lot of cash, that big working capital. The incomes from 14 to 19 were lower, and we saw a cash drain. So when we talk about the biggest component of land values being farm incomes, that we've been in this sideways channel because farm incomes were lower. Government support was absolutely critical during that time period to help keep incomes up at a level that was at least supportive for land values. And throughout that entire time period, interest rates remained historically low. And oh, by the way, the supply of farms were also below normal. So let's talk a little bit about farm incomes before we move to the other two. And these are just some things to think about. I'm not going to tell you what your break-even costs are, but I'm guessing on corn and soybeans, some of these numbers. This is a survey of our staff, and I asked them with rent, what's the cost to put out an acre of corn last year? $700 an acre is kind of an average. Soybeans anywhere from $300 to $550, probably closer to that $500, $550 number. So you start to do the math. If I can sell 200 bushel corn for an average of $4, which I'm thinking some people probably were able to achieve last year, because the average of $4 is not out of line with maybe what you sold earlier in the year and then later. So that's $800 an acre in gross income, not including the government support payments. So when you start to add all that up, that's a profitable year. And that is why I said earlier, I think working capital increases. So that also means rents for 2021 could also increase, and you'll see some more demand out there. And we are certainly feeling that on our farm management side. Farm incomes are increasing. This slide I pulled out just a couple of weeks ago because it's been changing, but this is from USDA, Economic Research Service, and I apologize for this being a little blurry, but it does show the big increase that USDA is projecting for last year's farm incomes. And see, we're getting back to a level that we experienced back there in that 07 to 12 time period. And that is one of the reasons why you see farmland values moving upwards. Now, I talked about the impact of government program payments, and this becomes really important as we think about what's going to happen going forward. This isn't just ARC and PLC. This is the MFPs. This is the COVID relief payments, all encompassing. And look at the inflation adjusted payments in 2020, all-time high, higher than all the payments back in the PIC days and early 2000s. So that, and in 2019, pretty big number as well. So those payments have been pretty important to the cash flow. And here's another way to look at that. Direct payment portion, payments to farmers is the orange part of those bars. So the overall income is the top of each bar. And you can see it increasing, slight increasing trend since 2016. And the orange part gets ever larger each year. So you take that orange part out, that's really not an increasing trend if you just look at the blue numbers. Now, again, I think 2020 gets revised upward higher, and that blue number moves up due to the higher commodity prices late in the year. Now, here's real net cash farm income, less the government program payments. And this talks about that declining trend that I just mentioned, that if you take the government program payments out of it, it's not quite as optimistic a story. Now, we all know that here in Indiana, not so much in Lafayette, but when you go Lafayette South and Lafayette and East, you get into some timberland. And here's the average value of timber. And trust me, timber was heavily affected by the tariff wars with China. And so this would be a more rosy picture had those not happened. But here's the average stumpage price per year, the last, oh gosh, back to 2002. And you can see, generally speaking, the last, since the recession, values of hardwood timber have been increasing. So that does help that part of the rural landscape here across Indiana. Here's the cap rate. This is something I mentioned in a discussion earlier today, and the person commented, oh yeah, you can really make 2.5%, 3% on a farm asset. Yes, you can. And so when your net is that, you're comparing that to other fixed income assets. So CDs, treasuries, all of which are returning at levels well below that. So why is farmland an appealing investment? This would be one of the reasons, an interest rate impact. So we talked briefly about consolidation. I've shown this slide maybe to you before. I think it's always helpful to think about what is happening from a scale standpoint out there. Consolidation in livestock has kind of already happened. The consolidation in grains is well underway. 2002, 6.7% of the farms produced 75% of the total sales. 2017, that's down to 5.16, probably 5% today. Farms producing 75% of the sales only own 37% of the equipment. And I put after that, basically suggesting we all know that a 1,000-acre farmer probably has enough equipment to farm 2,500 or 3,000 acres. He has that because if we get into a spring like 2 years ago, we need it. We got to go fast. But might he be over-equipped? And that's what this little statement says. Organics, 10% of the largest farms in the United States, 10% had organic sales. I would have assumed that to be a lower number. And then finally, on scale has its benefits. Farms producing 75% of the sales did so on 69% of the expenses. Just the ability to buy things cheaper. So cash rent results back in September. I'm going to quickly go through this. Back then, we were predicting steady rents for 2021. I would say if you ask us today, we would predict higher rents. In fact, some of our people were willing to lower cash rents back there on September 1st. Now, what is the supply of farmland for rent 2021 versus 2020? More. There's more out there. This was early September. Is there more or less demand? Well, the same was the large answer there, but still pretty strong. Any tenants default on any leases that we manage, and we're managing 600 plus farms? No, none. Will tenants give up their leases rather than renegotiate? Back then, 5 said yes. Well, I doubt that that's probably the same answer today. Big changes the last 5 months. Cash flex leases, we use a lot of those. This is a perfect year for an example of why a cash flex lease might be something to consider because it really represents the year you're in. And it takes actual yield times an actual price that could happen on the farm and generates a gross revenue. And if that gross revenue goes above a certain level that's negotiated, you might get a bonus payment to the landowner. So we do a high percentage of cash flex already and feel like that's a really fair way to compensate landowners when we don't know what's going to happen prior to the year beginning. So here are some of the base gross revenue numbers for corn and soybeans. Again, if you want these slides, be glad to send them to you. I don't want to spend a lot of time on this right now, but basically just gives you some of the data points that we use for base gross revenues and base cash rents in our leases or cash flexes. So here's the Purdue chart on cash rents, and you can see that this mirrors land values. So when I talk about farm incomes being critical to land values, this is the perfect example of that. This is cash rent returned to the land, farm income returned to the land, and you can see it looks just like farmland values with that slight increase this past year. Here's the USDA survey. I think this is interesting just to think about the entire United States. What's the average cash rent? $140 an acre. You could rent very few farms in the state of Indiana for that amount. So I always find that to be kind of interesting. But you can see basically the peak in 15, dropping back in 16, and then slowly increasing. Similar trends. So wrapping up here, some things to think about. Why buy farmland? First of all, we have the long-term world demand fundamentals. You've noticed, I think, what the corn demand from China has been. Record numbers of imports on corn. Soybeans, a lot of imports to China. Did you notice how much of their own wheat they purchased in their Chinese-led sales this last week? Why? Because corn prices are so high internally in the country. Point being, long-term world demand fundamentals do exist, and they're bullish for agriculture and therefore land values. Just-in-time delivery impacts. We don't have any storehouse of grain around the world. Today, the reality is when we get a hiccup, a derecho event, or somewhat of a drought in Argentina, you can see price react to that almost immediately. Interest rates, very favorable. I said earlier, lowest in history. So in the Chicago Fed 7th District, they record the average rate for real estate mortgages, 15-year fixed, at 4.24%, lowest ever that they've recorded in that survey. Supply of farms for sale remains very low. Government support in 21 is a question mark and something worth watching as we go forward. So when we talk about cropland values are certainly in an uptrend. I think, and I said this last week in our seminar, I'm still behind it, 5% up this year. That's maybe conservative. I've seen some reports out there saying maybe 10% on cropland values. Probably depends where you're starting from. But though that's certainly, those are increases that are very, very possible in light of the current economics. We foresee markets in timber, that's a question mark. That depends on trade and the overall economy. Recreational land, steady to stronger, and rural residential, I think, steady to stronger as well. One word of caution when you think about cropland values are those hassle farms or those farms. If you remember my slide where I showed recent sales, and we had the one sale in St. Joe County that was $42 a whoppy point, all the others were 55 or 50 and above. That was what I would classify as that average to below average farmland, and why you want to be careful when you just apply an average to any farm. So if you want to be bullish, and I just told you I'm bullish this year. So if you want to be bullish, here's why, and here's why I am. We got profitable prices, corn and soybeans, wheat, got a low amount of debt to assets, got low interest rates, and a low supply of farms for sale. You put all that together, that generally means land values are going to go up. Biofuels, demand is pretty steady. It's lower than it has been. Not many people are driving just yet. I think the Biden administration is probably supportive of biofuels. So I think that probably continues forward. World population growth, certainly we see that playing out in some of other countries like China. Trade deals are certainly helping. What was negotiated a year ago with the Chinese phase one was helpful. You do have the potential for inflation, and don't miss that. There are those investors, financial investors, who will look at farmland as a hedge against inflation, and they'll want to have some money there. So they could become a little bigger player here in the next few months. And then water resources and competition, buying farms that have good water resources, either from rainfall or from irrigation. If you wanted to be bearish, and again, I'm not a bear at this meeting, but if you wanted to be bearish, how could we see values go down? Well, if we got into another outbreak of COVID-19 or these variants, and the pandemic comes roaring back and we have to go back to a shutdown economy. That could be one black swan. Weather impacts and trade, impact on prices. Certainly, if Argentina and Brazil all of a sudden have plenty of rain the rest of the season and they get their second crop of corn planted, and we have a really good growing season, one might argue that that could be a negative impact on prices. Again, that's the next point. Global production is enough. Worldwide economy tanks. Well, that would be due to an economic shutdown due to the COVID outbreaks. Trade agreements or not, what's the new administration going to do with these trade agreements we have in place? How do they enforce them going forward? And then the RFS that the new administration tries to support, or what that mandate looks like. Probably the biggest concern is what happens with interest rates, because odds are they're going to go up. And that is due to inflation concerns. And then at that point, you start to see that interest expense go up, and that could be a damper on farmland values as well. So if you want to be bearish, these are some points to think about. But really, we're going to be bullish, or I'm going to be bullish at this meeting today. You watch other asset classes, stock market, maybe a little bit, but really when you think about farmland, it is a fixed income type of investment. And that's your liquid treasuries and CDs. And look at what they're returning. Higher interest rates make them more competitive with farmland returns, which they're not today. Watch the working capital concerns. I think those are largely over for now, probably for at least a year, maybe two, but you got to watch those. And then I'm just going to conclude with what I think are these very bullish fundamentals. Very simply, everyone, higher prices lead to more demand for rental land, which leads to higher land values when you put them alongside a low interest rate environment and very little farms for sale. So that's where I'm 5 to 10% up this year. I look forward to just a great year in the ag space. We are an essential business, thankfully. I think all of you know that. That's why you're invested in farmland, and it should be an exciting time. Here's a slide with my email down there at the bottom. So if you wish to send me an email and want to see my set of slides, jot that down real quick and we'll do so. So Nolan, with that, I'm going to conclude. And at this point, I'm very pleased to introduce Gary Chapman. Gary's an attorney at Bose McKinney and Evans. I think he's largely a work from home attorney at this point, but he has a long history with agriculture, knows it very well, grew up on a farm down in southwestern Indiana, just southwest of Indianapolis. But he has helped many of our clients with solar and wind leasing and with 1031 exchanges. We talked about the 1031s earlier. I think he's got some insight on that today, but he's going to talk a little bit about solar and wind leases. Solar is a big movement here in the state of Indiana, and you might be facing a solar leasing contract. You might be looking at one now for your own farm, and should I or shouldn't I? So I think Gary's going to point out some things to look for in those kind of renewable energy contracts and whether it's a good contract or not. He'll help you evaluate that. So with that, I'm going to turn it over to Gary Chapman and let him take it away. Nolan, I'll stop sharing my screen.
Let's see if I can get mine started.
All right, Gary, if you're ready, you can share your screen and take off whenever you want.
Are you seeing my screen? Do you see my screen now?
Gary, you are muted. I can't hear you.
Okay, let me try if I can unmute. It says I'm unmuted. Can you hear me?
Yes, we can.
Gary, you might have to switch the microphone on your computer, or there's a phone number on that link I sent you. You can call in for audio.
I think some of us can hear him.
We can hear and see.
Okay, good.
Yep.
There, we got you now.
Okay, we're going then. Hello, everyone. This is kind of a first Zoom presentation. I've done a lot of presentations for Howard, but I've never done one on Zoom, so this will be a first. As Howard said, I've worked with Howard and the guys here for a long time. I've been a part of a lot of these meetings, so many of you probably have seen my face before. I started back on a dairy farm many years ago. I was went back after college with my brother and my dad for about 6 years in 1980 to 86 on the farm. Howard mentioned those of us that are around and remember higher interest rates. I certainly remember them from those years on the farm. Went into the dairy buyout program in 86, went back, took that opportunity to go back to law school and started with the firm I'm with, Bose McKinney in 89. And since for the last 30 some years now, I've worked with, a big part of my practice has been with agriculture and working with landowners, both in succession estate planning, but also just their general real estate needs. Today, I wanted to focus a little bit on wind and solar leases, because one of the issues I've dealt with beginning about 12 years ago was when those big windmills first started hitting into Indiana. I worked with the Meadow Lake farm up in White County, and I represented probably a group of 4 or 5 large landowners. And we sat down for a period of a good, I think it was a 6 months or so, because this was early on in the wind and solar leases. And I worked with the folks out of Houston, and we put together a lease up there that seemed to be pretty, it was geared at protecting the landowners, but yet being a workable lease for this new type of energy structure. And since then, over the last 10 to 12 years, I probably worked on at least 6 or 7 major wind projects. And in the last 24 months, I bet there's been a dozen solar leases, because at least solar leasing is becoming, about 5 or 6 years ago, you saw some solar leases pop up that were for 80-acre farms, 100 acres here, 100 acres there. And the the energy companies had to buy so much green energy. So they were incentivized to buy a little bit of solar energy from these small farms. So you had a lot of these agents going around locking up as many of these 80-acre parcels as they could, and then they would market those, and the ones that had the most potential would get a small solar lease. Quite honestly, I don't know that I ever saw any of those fully materialize on those smaller scales. But what we've got going on today is a whole different environment. We have, like I said, in the last 24 months, I've worked on no less than a dozen solar leases here in the state of Indiana. Most of them are 200 megawatt type of projects. They're going to contain 1,000 to 2,000 acres. It was interesting. The IBJ did an article on solar leases not too long ago, and they had a list of 20 different solar leases in the state of Indiana. And of those 20, only 2 of them were part of the 12 I'd worked on. So, I mean, there are a lot of solar leases going on in the state of Indiana. So if you're a landowner, you've probably been approached by somebody about a solar lease. There are still wind leases going on. In this last year, I did 2 major wind leases up in Blackford County, actually 3. I mean, I've done one for EDP and one for RWE up there. So the wind leases are still active out there. Meadow Lakes continues to expand their operation over in White County into the northern county and doing more phases. And there's been some others up in that area. So what I'd like to do today is just kind of focus on some of the key terms. If you get one of these leases in front of you, what should you be looking for? What sort of things are negotiable, what aren't, and what success I've had over the last couple of years in negotiating with these, and then leave some time for questions if we've got any. One of the things I found in negotiating these leases are you're much better off, particularly on the wind side, because the wind leases involve a lot more acres. And so on those situations, if you can get a group of the larger landowners together early on in a project, when the wind folks first come to town, you can make a lot more headway in negotiating and working with them in a lease that fits what the needs are of those landowners. If you get a lease presented to you and there's already 15,000 acres already signed up and you're 100 acres added onto the end, I mean, I can look at the lease, explain it to you and tell you what's good or bad about it, but we're probably not going to see a lot of changes at that stage of the project. Solar leases, because they're not quite as big, not as large of acreage. I've done a couple solar leases where I've had one landowner with 1,500 acres and that's the only landowner in the lease. So there we've got some negotiating ability, because just because of where that land's located, it happens to be under the power line they want to hook into. They've got one landowner to work with. That is much easier to, and they're much easier to negotiate and get some favorable terms. So that was one of the key things. So now I just want to take off and let's just take a look at some of the key provisions. This is a long-term lease. So you better get it right up front, because when you add up all the various option terms, operation terms, all those, you may end up with a 50-year lease. So you want to make sure you get this right up front. Most of your option, this applies to both solar and wind. They'll either have an option agreement that'll be 2 to 5 years, or there'll be you'll sign the lease initially and there'll be a development term, basically the same as an option term. They'll have 2 to 5 years to work up the project, figure out where they're going to put, if it's a wind, where the turbines are going to go, and if it's solar, what exact acres are they going to use. They come to you then at the end of that option period and they'll present a site plan. On the wind turbines, it's going to say, okay, on your 360 acres, we're going to put 3 turbines and here's where they're going to go. And you early on in the original White County Meadow Lakes agreement, we negotiated hard and we got landowner approval of that site plan. I'll have to say that's about the last time I got it, because in most of these subsequent projects, by the time a wind company or a solar company gets to that stage of the project, they've invested a tremendous amount in engineering cost and plotting out where everything is going to go. And they're much less, I've been much less likely to get that carte blanche site approval, at that stage of the game. But with the EDP leases here in Indiana, you still get that. So if it's an EDP lease, when they get done with their site prep and everything, they're going to present it to you. And you've got the option at that time to say, nope, I don't want my towers there. So therefore, now they may say, okay, we're not going to take your land and you're out of the project, but at least you've got the right to do it at that point. So I will argue for that in the lease if we can get it. The solar leases that are kind of a single person project, we may get that. I've gotten variations of it, site approval, not to be unreasonably withheld types of things. But I think the one thing with that, and I think if you talk to Meadow Lake or EDP, they'll tell you that it develops so much goodwill with the landowners that it was the few times that they had to negotiate at all, it was well worth it, because it makes it so much easier to get that lease signed initially when the landowner feels that they've got the ability to say have a say about where it goes. When we can't get that kind of agreement up front in a lease, and you're not going to get it in all these in the various leases out there, what I tell the landowner is, if there's land you don't want in that project, or there's a place you don't want a wind tower, you just don't put that land in the lease to begin with. You just take it out up front, and the land, the wind companies will let you do that. But that's the only clear way at this point to make sure you're not stuck with a tower someplace you don't want it. The operation terms will be anywhere from 25 to 35 years, depending on what the lease and the company. And then they'll usually have a renewal term. And initially those renewal terms were, 5 to 10 years. I've seen recently in some solar leases, I've seen a 25-year renewal term, which would make that lease something like a 50 or 60-year lease. And that's an extremely long lease. And I've had some landowners push back on that, because, it's hard to predict what the world's going to be like 60 years from now, and whether this is a good deal, even with some inflation factors. The one thing you need to remember is these leases are a little bit one way, because the solar and wind company, they reserve the right to terminate this lease at any time. They can walk away from this lease during the option period if they exercise their option and they put up a few towers. If 10 years into it, it's not productive for them and not economically feasible, they can terminate that lease. And so this isn't a forever type deal from their side, although you're locked up for a long term as long as they're exercising their option. So one of the things that we'll talk about is, what sort of provisions do you need in that lease at the termination to get your property back in the shape that it was before you leased it. And I'll hit on some of that in some of these other terms that we're going to talk about. So let's talk about rent and what you can expect to see and what components and how it's made up. Almost all of them will have some sort of a signing bonus, and that can range, again, depending on the project, depending on how close you are to the substation, depending on if they need your property in just to connect. That ranges all over the board. Sometimes they'll start out with a $10 an acre or a $20 acre just signing bonus if you sign up by a certain date. Don't let those dates scare you too much, because I've seen those dates, they get pushed out and pushed out and pushed out and pushed out, because they're going to, if they pay anybody a signing bonus in a project, you're probably going to get one if you eventually sign up. So don't let those scare you, but they range with every project. During the option development term, the rent's going to be somewhere between $20 and $40 an acre. Some of them have the first 2 years or first 3 years, it's $20. Then if they extend it past that, it's $40. They just have all sorts of variations. Some of them, it's a 5-year development period and they'll pay $20 up front. So they'll give you $100 up front, and that'll be your option payment for the entire 5 years. I've just seen it kind of go all over the board, and that's during that time period, that's just found money, because you're still farming the ground. There's no facilities on it. They may keep the wind company may have the right to put a Met tower up, which would be a very small little piece of ground that you'd have to give up, but and they may come out and do some surveys or whatever. But for the most part, during that time period, that's just extra money for that land, because you're going to get full rental value from your farmers if you're renting it, or your full access to farm it. The next stage you'll get into is a construction period rent. This varies a little bit between wind and solar. Wind, as you know, with a wind agreement, you may get 3 towers, 4 towers on a 300-acre property. And so it may not even touch a portion of your property. So you're not even going to have a big hunk of your property is not going to be affected. You're still going to be able to farm. They're going to construction will take up more space than what they eventually will in the final lease. And so there will be some crop damage and there will be some other things. And what you'll find is most wind companies will pay you a % of the operational rent all the way up to 100%. Some of them start at 50, some will just offer you the 100% of whatever operational rent would be during the construction period, just to compensate for the inconvenience of having such heavy equipment on the roads around you, having to work around all that. And it does create a pretty, there is an impact. You're going to feel a wind construction project on your farm. The solar, solar is a little different because when the solar comes in, once they break ground and they start working on your farm, they're pretty much, it's all or nothing. I mean, they're gonna, if they're putting solar panels on the whole farm, they're gonna take over the whole farm. And so the construction period on that may be about the same length, but you're not gonna have use of the farm during the construction period at all. And so we'll talk a little bit about, how the rent goes for that. So most of the time in a solar agreement, I'm going to fight to get 100% of that operational rent from day one, because you're taking it off the, your landlord, your tenants aren't going to be able to farm it. You're not going to get any rent from your tenant that year. And you need to be compensated for that at the full boat, at the full rental rates. And we'll talk about those in the next page. Crop damages again vary a little bit between the wind and the solar. The wind, you're going to have, the main thing you want with crop damage is just an accurate way of calculating. You need, price, bushels, how we're determining price, how we're determining bushels, and how we're determining the damage. And as long as you've got those things covered and you've got a clear way of calculating it just on the raw crop damage, that's probably going to be what you need. And over the years, I'm not making much changes in those anymore, because early on we did, because it was new. When these companies first started coming to the Midwest, they weren't comfortable with row cropping and stuff. But now most of the time the crop damages are fairly easy, and we're not going to change them. The one thing with wind that you've got to watch out for is you got to have adequate compaction damages. Those cranes that they put those towers up with are huge, and you are going to have some severe compaction on those crane easement paths that they bring those cranes in. And so what we did in Meadow Lakes is we didn't want to deal with crop damages forever. So we finally compromised and ended up with a 4-year. We just took, if it was compaction damage, you got 4 times whatever the normal crop damage would be, thinking that it took 4 full seasons and some heavy ripping equipment to get that back to where it could be operating, and still understand that you may not have it all the way back in those areas where they did the compaction. But so that's the one thing you want to watch out for in the wind agreements, is you want to make sure you've got adequate compaction damage. On the solar side, again, depending on when they start, you may not get crop damage, because if they give you notice that they're going to start, the project in February before the corn goes in the ground, and they start paying you rent then, and you're getting $1,000 an acre, you're not going to get crop damage because you didn't plant any crops and there wasn't anything lost. If they come to you in May and say, hey, we're going to start construction in July, and you've already got your crop planted, well, then you're going to get that 1 season's worth of crop damage, and they'll limit it usually to 1 season, because once they start and they're paying you that acreage payment, then there's no reason to pay you any more crop damage, because they're paying you for the entire farm. The other thing that you need to focus on is adequate tile damage provisions, because they become a little more important in the wind agreement, because you are actually farming the ground in between the wind towers. So if they've damaged that tile, you immediately feel the results right away, and you need it fixed, and you need it fixed soon. You don't want it delayed. So you need some I like to get in some self-help provisions that says they've got so much time to do it. If they do it, they need to provide you GPS photos of it, GPS tracking of where it is, and they need to use the approved, tile people that you suggest. And if they don't, you need to be able to step in and do that. Most of the time, they're pretty agreeable with that. And I haven't talked to too many farmers after the fact, particularly in the Meadow Lake, that really had much issue up there with that. Your tile damage on a solar project is really kind of different, because once they take over the whole farm, you're not farming. You're not concerned about how well that farm drains. they're going to be concerned about how well it drains just because they don't want their solar panels flooding, but they may not need the same drainage as you would for a crop. What your main concern there is they keep the main tiles open. You're not impacting drainage on neighboring farms, which you may own or your neighbors may own. So you need to have provisions in to cover that. And you need to have provisions in that, all these will have termination provisions and what happens at termination and how they have to put it all back to the way it was when they turn it back over to you. But I will always add just some extra language, including tile. You want that tile working when you get the farm back the way it was working when they took it over. They come in and put pylons about 6 feet down in the ground for every one of those solar panels. And when you look at it, if you've ever seen a solar field, the one by the airport, I mean, those pylons are down very frequently. There's no way they are not going to hit multiple tiles when they do that. And so the tile repair that needs to be done after a solar project is fairly significant. And you'll get most of the tile people although we talk about not needing that repair completed until they turn it back over to you, most of the ones I've talked to will attempt to do it at the time because they just, it's easy. They've got construction people out there, they're doing it and they're going to try to fix it. But that I've had a lot of people that, and we've talked in some instances, I've actually talked about, where you just put $1,000 an acre in tiling on a field and the solar company comes and talks about taking your property. Well, it's hard to give up that farming ground when you've just made that kind of an investment in tile. We've talked about having an escrow fund where we have the solar company escrow money that will make sure that you've got that, so that you've got that fund available to put that tile back to the way it was. So that's the thing I will look for there. When we look at operational rent, the wind operational rent, it's very complex with multiple factors. They're going to pay you so much per megawatt, and each tower, the towers vary. They're going to vary. Originally you may have had 2 megawatt towers. Now we're talking about 4 to maybe even 5 megawatt towers. So it's all going to be a component of megawatts per tower and what the price is per megawatt. You're going to get easement payments for all the underground and overhead transmission lines. You're going to get payments for the road accesses, the access roads to all these towers. So it's hard to come up with a number here to show you what those wind leases are, but it is not unusual that they would come up, well in excess of 10,000 a tower. So you're seeing towers out there. The wind lease payments are probably in excess of $10,000 per tower. And the different companies have all sorts of different ways of sharing land. They'll pay you a set dollar per land, and they try to share some of the factors and spread it out among everybody. So they make, let's say you're in the project, they need you because they need to cross you to get to that next tower, but they're not putting a tower on you. Some of the wind companies will have a factor in there that shares if there's X towers on that whole project and your acreage is X% of the acreage in the project, you get a percentage share of that just so that you share a little bit in that. And again, they're all different. What that boils down to is, I know up in Blackford County this last year, we had, I think, about three separate wind projects going in at the same time. And some of them were competing with each other. And so what you need is somebody that understands the math. And I had spreadsheets set up that would put everybody's particular instance in and then show them, okay, if we go with this company, here's what your total revenue is. If we go with this company, here's what your total revenue is. So when it comes to the wind agreements, you've got to have, the wind companies will attempt to do that, and they'll do some back of the napkin type numbers for you. But you need somebody that can go all the way, particularly when you're competing and you're looking at different projects. You need somebody that's going to dive in and be able to compare them for you and show you the difference. The solar projects, I mean, it's much more basic. I mean, you're talking it's a dollar per acre type of situation for the leases there. They may have some other situations where they are property that's not what they call on-site, but adjacent property. They may retain it at a smaller per acre value or an easement rent value. But for the most part, you're just getting an X dollars per acre. Those rents have ranged anywhere from $700 to $1,200 an acre. And so those are a little simpler to compare just because they're basic acreage. The one thing there that I found that I've seen to be able to make the most difference on is, as I mentioned earlier, the solar lease or all these leases, they have a right to terminate at any point in time. So they can, if you sign up 300 acres, they can, maybe they put turbines on or solar panels on 250 acres, but then 2 years into it, they figure out they're not making any money. They want to move those solar panels somewhere else, and they could cut you down to only 100 acres. Well, you've kind of rearranged your farming operation to accommodate this solar project, and it wasn't, and maybe they only take 40 here, and it's kind of messed you up. So what I do to avoid that is I put a minimum acreage protection type language in that says, okay, yes, you've got the right to terminate, but usually I try to set it at least 75% of the acreage going into it, that in no event will the rent be calculated on anything less than 75% of what the original acreage was. So you can cut me to only 100 acres, but you're going to pay me for 75% of 300. And so I don't care, because I'm getting paid for that. And if you want to remove your panels and go somewhere else, that's okay, but you're going to pay me for that. Most of the time they have agreed to do that. It is not in their, a solar project works best when it's contiguous. And if they can put panels next to each other on your farm, they're not going to want to move them. So there's not a lot of incentive for them to do that, but they have the right. And I try to do something that will protect the landowner from that happening to them. And so you can get a minimum acreage protection type language in there. The biggest thing when it comes to operational rent is this inflation factor and how they calculate it and what they do with it. Almost all of them will use a 2% annual increase of some sort. I have seen a few solar leases that will use a 2.5% when they're not using a CPI also adjustment. What I'd like to see is the greater of 2% or the CPI increase over the prior year. That will account for inflation, and in those hyperinflation years will keep this lease up with inflation. A 2% appreciation in the 80s would have been pretty nominal, and it would have put you behind very, very quickly. Almost all the wind leases I've done have been open and will do fine with the greater of the 2% or CPI. For some reason, the way the solar leases contract on their long-term power agreements and things, they have pushed back on it. And I've had several of solar leases that just, no matter how, it's take it or leave it, this is what it is, and there's no CPI in it. And that's the one that did that. They would rather raise the annual appreciation to 2.5% than to grant you a CPI. So that's the other factor I find out there. The other key about inflation factor is, when does it start? This factor, if it starts the day you sign the lease, which is what we negotiated up at Meadow Lake. So if they signed those leases in 2007 and they didn't have any wind turbines until maybe 4 years later, those megawatt payments were appreciating at CPI or 2% beginning in 2007. So by the time 11 got around, they had if it was 5 years or it was 12, they had a 10% increase day one. Most of these leases, when you get them presented to you, they will start the appreciation the first anniversary of the operational period, which is more than likely going to be 6 years out. And if you wait 6 years out to start, when you're comparing leases, you need to factor that in. And so, in one situation, we had a solar lease that they were bound and determined they were not going to start appreciation until 5 years out. That was, but they offered $1,000 per acre up front when the competing solar company in that same county was offering $900. So when you did the math and you compared them, they ended up fairly close because the appreciation of the one got to almost $1,000 by the time they were kicking in. And then in the latter years, the 2.5% probably was going to give you more appreciation. So again, math becomes important, and you've got to understand and analyze these because they're long-term, and you've got to be able to look and calculate present values of them and what impact they're going to have on you in the terms. The other thing that it's amazing to me, I mean, you would never get a mortgage from a bank that didn't have a provision for late fees and interest if you missed your payment. Quite honestly, these long-term lease payments on 30 years is very similar to a financing arrangement. It's very much like, but I'll bet you 60% of the leases I'm presented have no late fees and no interest penalties in them for paying late. And so that's the other, I normally will argue and get those put in. Again, the Meadow Lakes project, quite honestly, EDP is a great company to work with. And for the most part, I think most of my farmers were happy, but because that was kind of a new area for them, a new project up there, in those initial years, they weren't always timely paid. And they were very glad they had those interest and penalties in there because it kept their feet to the fire, and it got the payments made a little quicker. And when they were late, they got some compensation for it. So that's something you want to make sure you get in the lease. Easement language. We talk about wind lease. I'm about out of time. We talk about wind lease easements for the wind and solar for the solar, but they also are going to grab access rights and try to, and most of them, what I'm saying here, easements over other property, they may say in there that you grant them an access easement over any adjacent property you own to get access to this property. Well, there's no payment for that in the lease. And I'm okay granting them an access easement if they're going to pay you for that. So most of them don't provide for that. They just stick it in there and think that you're going to sign it and give it to them. Same thing with setback laws and things like that. You're waiving all setbacks. Well, that's fine if they're paying you for it, but if they're not paying you for it, we need to remove that provision. Transmission lines, overhead versus underground. In the Meadow Lakes agreement, we took out all overhead transmission easement rights. And if they wanted overhead transmission rights, they came back and negotiated those separate with the landowner. Overhead transmission easements are a whole lot different than underground. You've got poles to farm around, they're sticking poles in your field. And it's a whole lot better for the farmer or the landowner to negotiate one-off those types of deals. And I'll guarantee you'll get a lot more, if you agree to it, you're going to get a lot more revenue for those overhead easements if you're negotiating them on a one-off deal than if they stick them in the contract up front. If they refuse to take out the overhead easements, I just make sure I get significant comp for them above what they're paying for the underground easements, because it's worth a lot more for them, to the farmer, you need more compensation. Substations, I take those out. That can be negotiated separately. You don't want to grant them an automatic right to set up a substation on your property. That's something you don't want to do. You may want to sell them property to do that, and they will pay handsomely for that privilege to do that. So take that out of the lease, and we'll negotiate that later. Then just some miscellaneous things, assignability of the wind by the wind and solar company. A lot of these companies are out there just putting these deals together, and their intent is to assign it to somebody else to manage it immediately. You want to make sure that whoever they assign it to has the wherewithal to take on this responsibility and do that. So you don't want to just routinely accept their assignability without some sort of net worth requirement on whoever's taking it over. Insurance coverage. There's a lot of liability with these tall towers, and you need to make sure that they've got enough insurance coverage to protect the landowner and protect your people on the place from any hazards that might come with that. Property tax, that's there's going to be a provision in there that says they're going to pay any increase in property tax. Sometimes that's hard to calculate, and and there can be some confusion on what that is. It seems a little easier in the wind deals because the property that they put on there are limited to 3 towers, and it's a little easier to figure out what that is. In the solar panel deals, you're talking a ton of facilities that they're putting on that property. What I have seen done in the solar deals, I've seen, rather than worry about arguing about this, we just have them pay 100% of the property tax. It's like a triple net lease that you would get in a commercial context. they're leasing it and they're going to pay the property tax, that might, you might get $25 to $30 less a acre on the rent payment, but it's worth it just so you don't have the hassle of calculating what the increase is, and they take over all property tax. Environmental issues, substations, and battery storage. On solar, battery storage will be probably a part of every solar lease. Those are lithium batteries. There's some environmental issues associated with that. That's just a part of the project. You're going to have to deal with it. And that's why I just want to point that out, that you're accepting that kind of a hazardous substance there on your property, and you need to make sure that insurance coverage is enough to cover that. And then final, removal security. Just need to make sure that when the time comes, and if they're going to have to take these things out, that they've got bonding or they've got security, something posted that's going to give them enough money to get your property put back to where it needs to be. Mainly, does the requirement that they post it start soon enough, and is it adequate? A lot of these agreements will come to you and they won't have to post any security for the first 15 years on the argument that their equipment is worth so much that that alone should cover any removal cost. I don't know about you, but I don't want to have to argue over what the value of this big old 500-foot pole is. I just want them to get it removed. And so I start the security right away, and I provide that there's a minimum bonding requirement regardless of what the value of the property is. So those are the two things I will fight for to get in there. That pretty much, and I kind of felt like I did this in a whirlwind, but I see my time's up, so I don't want to take up any more time, but I'll be glad to answer questions, or with that, I'll just turn it back over to, I can let go of the screen here and turn it back over to, if I can find it.
Here, I can turn you off, Gary.
Okay, you turn me off.
All right. Well, thank you so much, Gary, for that. That was very informative. And yeah, and we can follow up with you if anybody has any questions. We can forward those along to you, or if you have contact information you'd like to share. With that, I think, Natasha, if you'd like to introduce your team, Cody and Savannah, who will be presenting on the risk management at this time.
Well, good afternoon, everyone, and thank you for allowing us to join you today. From Farm Credit Mid-America, I have Cody Gold, who is a Regional Vice President of Crop Insurance for our organization, along with Savannah Steinke. Today, they're going to update you on farm programs and some risk management strategies for your operation, not only to be used for making decisions this year, but for looking into the future for decisions. Both are Boilermakers by heart and reside in West Central Indiana. Cody and Savannah, I'll turn it over to you.
Can you hear me, Sasha? Nolan?
Absolutely.
Okay, all right, thank you. Sorry, got double mute, gotta love it. All right, thank you so much. So just real quick, this presentation is intended for informational purposes only, not for public or media consumption. So any opinions expressed by Savannah or I, those are opinions, and Farm Credit Mid-America is an equal opportunity provider. Natasha, you stole a little bit of our thunder, but that's okay. We'll let Savannah here go ahead and get started.
Thank you for joining us today, and thank you, Nolan and Abby, for having us. Again, my name's Savannah Steinke. I'm the crop insurance specialist for the Lafayette, Williamsport, and Rensselaer offices.
Yep, good afternoon. Again, not to repeat, but I am Cody Galt, Regional Vice President for our crop insurance team. I'm out of Southeast Indiana, Greensburg, and I have the pleasure of leading our Indiana sales team and work directly with Savannah. Just a little quick overview of Farm Credit's crop insurance in Indiana. With the help of Savannah and 16 other crop insurance professionals, we insure 900,000 acres with over $22 million in premium. Today, just want to thank you for joining us, and our goal is to provide you with additional resources and information to aid you in your 2021 risk management decisions, specifically with crop insurance and farm bill elections. if you have questions, please feel to chat them in. And if we have any time at the end, we would love to answer those if time allows. So at Farm Credit, we truly believe, we truly do work hard every day to help you and your family have a secure future. All of us on this call I believe, are fortunate to have the professional Farm Credit team as resources to help accomplish that goal of leveraging opportunities and mitigating that risk. As we all know, there's plenty of that out there these days. And, Natasha had the pleasure of introducing us. I say pleasure, but we like to give her a hard time. But we do work very closely with our loan counterparts, and we believe trusted teams execute plans better. And we truly do love the work it takes to provide that service and earn your trust. So specifically, as crop insurance agents, we do this by helping you avoid a loss and lock in a profit. Right now, it's really exciting. Howard alluded to the prices right now. You've all seen it. It's been a bit of a yo-yo. We haven't seen these prices since 2014. And now, as much as ever, we're in a better position to lock in that profit and avoid that loss. So we all know that just because the prices are high right now, that does not mean they're going to stay that way. We can have the best weather information, market foresight. We just don't know that future. So that's why we believe that we can set a floor and price on that yield today, and then doing it now in the next 45 days. So at Farm Credit, we've invested in an exclusive decision-making tool that offers technology to help you make the best decisions for your operation, best utilize all the new complex products available in the crop insurance world. If we can use this tool to show you what raising your price and yield floor to a place that sets up you to cover your cost, we think that's an excellent business principle to have. And if we can use this tool to help show your premiums and guarantees and also bring your financial officer into these conversations because the information is simple and easy to read, we think there's a lot of value in that, the simplicity aspect of it. We know this will help aid your operation for success in 2021. So we'll touch a little bit more on this decision tool that I mentioned. You're going to hear me talk a lot about it. But for now, what products should we be considering for 2021? Outside of the traditional multi-peril products, such as revenue protection, that's probably the most common one you may all have or have heard of. There are a multitude of what we call private products in our arsenal. Private products are individual products offered by various approved insurance providers. They can cost different between the companies, and they can provide different benefits. Our relationship with the best approved insurance providers, we work with 5 different ones, have lined us up to offer the top of the line pricing products on the market today. So as mentioned, for corn and beans, we all know that the guarantees are going to be established here soon, and that's determined on March 1, and we use February for the discovery period, and then we do that again in November to establish what we call the harvest price. And so that allows us to determine a revenue to count and possibly establish a new guarantee if that price would happen to go higher in the fall. But as we all know, more times than not, there are different months throughout the year that offer higher prices. So what does that mean? We have access to pricing products that allow us to capture those different months or intervals. These products also offer options to buy yesterday's closing price on the market. So think back, let's rewind to last Friday. That sounds pretty attractive. I know that we've had a bit of a rebound here this week of the markets, but come Saturday, I have a feeling if you were interested or had access to this product, you would be your mind would be at ease, that's for sure. So on top of that type of pricing product, there are other options that allow us to simply add 25% or 25 cents, onto the spring price or price we determine in February, as well as just to buy up to 95% coverage. That would be the most common kind of 3 private products. So things just to think about as you're looking at all the decisions this year, and really depending on your operation, one or some of these products may be a great fit. And so I'd encourage you, like I said, be educated, know the different options. So now I'm going to turn it over to Savannah to discuss some new and exciting options for 2021 that offer not only high coverage, but high subsidy to maximize your protection.
Thanks, Cody. We all have risks, but it's how we manage that risk that gives us opportunity to meet our goals and remain profitable. The key is to transfer as much of that risk somewhere else. And how can we do that? By utilizing the federally subsidized crop insurance programs. This year, we saw several changes in crop insurance. And please know that we at Farm Credit Mid-America are here to help you navigate these changes, so you can take full advantage of these policies and options available to you that provide the highest minimum revenue guarantees for your operation. Within these changes, we saw the creation of a new policy option called Enhanced Coverage Option, or ECO. I want to take a few minutes this afternoon to talk about it because it can be a game changer for your operation. ECO is a pretty simple product. If you understand SCO, supplemental coverage option, you know most of what you need to know about ECO. It's federally subsidized, an area-based plan of insurance that works as an endorsement to your individual coverage and provides a 90 or 95% coverage level all the way down to 86%, which is where SCO coverage begins to trigger. If we remember, SCO provides area-based coverage from 86% down to where your individual policy ends, which in most cases is that 75 or 80% range. ECO begins to trigger when the area revenue drops below 95 or 90%, whatever option you purchased, of the expected area revenue, which is a combination of both projected price and crop insurance county yields. Keep in mind that ECO expected and final yields are based on crop insurance county yields and not your individual producer yields. Sign up is now open through March 15th, with any claims being paid once the county yields are published the following June. It's important to remember area-based plans and individual coverage trigger independently, and depending on the situations, it's possible for a grower to have a claim without having an ECO claim, or an ECO claim without having one on your individual policy, or having claims from both programs. Or if we have a year with great prices and great yields, no claims at all. There's a lot of ways these policies can trigger, but what's important to remember now, with the addition of federally subsidized coverage levels as high as 95%, you can expect that over time, these policies will create a positive cash flow back to your operation. And we have the math to show you how these policies work. A few disclaimers on enhanced coverage option. To be eligible to purchase, it must be attached as an endorsement to an underlying individual policy. You can purchase ECO alongside supplemental coverage option, and there is no linkage requirement to your Farm Bill programs. If you remember SCO, you have to elect PLC. However, ECO cannot be purchased in conjunction with other area plans such as margin protection or your GRIP policies, area risk protection policies. Over the years, the expansion of crop insurance choices has made selecting the best policy somewhat complicated. Today, there's many policy choices, and it might mean stacking multiple products, options, or endorsements together to get that coverage you need. Although these policies are stacked due to different coverage ranges, keep in mind that ECO is like all other area-based plans of insurance and triggers independently from your individual plan. How will you know if you're a good fit for ECO? One way is we can look at it by analyzing how well your individual farm tracks with area yields. With technology available to you through our commitment to our products, we have the ability to show you your yields stacked up against your neighbors. It's not necessarily as important if your track lower or higher, but what is important is the correlation between your individual farm yields and county yields that show us how area base plans such as ECO, and their performance over time can provide benefit to your operation. All right, let's talk Farm Bill elections. Remember, these are now yearly elections, and any changes to be made at FSA are due March 15th. You have two options, ARC, which stands for Agriculture Risk Coverage, and PLC, Price Loss Coverage. Prices today are much higher than the triggers of these programs. It seems that we are far above any price triggers alone. First, I'm going to discuss soybeans. If you look at the numbers, the PLC reference price for beans is $8.40. And for ARC, our 5-year Olympic average base price is $8.95. Just between the two programs, ARC has a higher protection. ARC is a popular program of choice among land-grant universities and ag publications. I too also strongly recommend ARC County for producers buying an 85 revenue protection plan, a margin protection policy, or perhaps your base acres are much higher than your actual planted acres. For some, I think PLC could be a better option on soybeans, even though the ARC safety net is higher. Producers falling into this category is producers planting more bean acres than they have base, or producers who picked up a new county in their yield history. They're working on building their yield history. My thought process behind this is the trigger revenue for the ARC program is low compared to what is available through crop insurance this year. Specifically, the supplemental coverage option, SCO. SCO is a highly subsidized crop insurance option that you can add to your policy if you elect PLC. I want to point out PLC is a great option because of the opportunity to lock in the price safety net at a projected $11.50 on all planted acres instead of just $8.95 with ARC covering 85% of your base acres at the FSA office. That's a net difference of $2.50 per bushel. Now on to corn. Our PLC reference price is $3.70 and ARC price trigger is at $3.70 as well. Us, along with most sources, are suggesting PLC. The revenue has shrunk greatly in the ARC County program, and we would have to see both poor yields and poor prices to trigger an ARC payment for corn. Good news is that the market is around $4.40 today, and your insurance policy will capture that extra 70 cents a bushel, more than the Farm Bill options. You can't save your way into prosperity, but federally subsidized policies are available for a reason, and it's because they work. We have the tools and data to help you make the best decision going on into 2021. Now Cody's going to discuss the new COVID-19 stimulus package.
All right, thank you, Savannah. Great information. I'm going to shift gears a bit here and look toward the Farm Service Agency programs outside of our traditional ARC and PLC programs that you just heard Savannah talk about. As you're probably aware, Congress approved a $900 billion, that was a B, not an M, billion-dollar coronavirus relief package that was signed into law December 28th. Part of this bill is that agricultural products will be eligible for a $20 per acre payment on price trigger and flat rate crops produced in the 2020 crop year, which are basically the same crops that were eligible through the past CFAP 2 program. Money has also been allocated to compensate farmers affected by payment limitations in the previous CFAP 1 and 2 programs, which I think is very interesting to see how that will play out. We don't have those details yet, as well as some other dates and whatnot, but again, more details to come on that for sure. On the livestock side, assistance will also be available to broiler producers due to the supply chain disruptions, and that can include payments up to 80% of their losses. The dairy sector will receive additional protection as well, as compensation for donated dairy products and for other beef cattle producers. It looks like an additional inventory-based direct payment per head on the beef cattle side. So again, I mentioned there's still a few unknowns. We're learning more every day. How these programs will be administered and the timing of these payments are still unknown. We've spoke to some of our FSA contacts that the March-April timeframe has been thrown out there, but again, nothing is set in stone. So I guess I would just ask, stay tuned, but literally more to come. So in some good ways. So we talked about a lot of options today, a lot of details. I know it's a lot to decipher through. It can be challenging for Savannah and I, and we do it every day. It's easy to get lost in the details and lose focus of the big picture. In times like today, when we have the opportunity to lock in that profit, running out of words for the day, my apologies. It's more important than ever to stay disciplined, have that plan in place. And we just want to let you know that we're here to do that. We're here to help you to take that burden off of you. So how do we do this? How do we help you and take that burden off? Savannah showed you a glimpse of our ARC and PLC tool and didn't go into the details of that, but that's an analytical tool that we can run any scenario of price and yield under the sun that you would like to get in there to determine what plan works best for your operation. The other major component of how we build your comprehensive risk management plan is with what you're seeing on the screen, and that's our exclusive decision-making tool. We partnered with a developing consulting firm and a few other farm credit associations to bring this unique tool to market. We've invested in this program for exclusive rights for our customers, and this tool will allow us to help you make more accurate decisions based off of your farm's records, your yields, your acres, all of your data combined, the full gamut of possibilities. So what makes it unique? You've probably heard this before. This tool analyzes all possible combinations of policy changes, simulating each through thousands of the most likely market, weather, and volatility events to show you a non-biased anticipated outcome. That anticipated piece is the big part of this. It projects the best option looking out. So in this chart, again, I know it's a bit busy. It's a snapshot of a policy in Indiana, and it captures the top recommended choices for this customer based off their yields and a multitude of products in there. This specific one is showing revenue protection, area protection, and what it would look like if we were to add an area plan that Savannah mentioned of SEO. And again, SEO is on top of your revenue protection plan. So the program we're looking at considers all the options, considers the thousands of scenarios, and presents us in what we believe is very easy, readable, a list of top suggestions. And it just by chance is, or it defaults to sort by net return per acre, and that can be changed. It's what's most important to the customer. Is it bushels? Is it marketable bushels? Is it dollars per acre? We can get that tailored solution for you. So all in all, this tool, very, very excited about it, is most certainly a game changer. Its capabilities are new and exclusive, not only to farm credit, but the crop insurance world in general. And we believe it'll be critical to your future financial success. Again, I've worn out the word exclusive, but it is exclusive to us and for our customers. And all of the crop insurance specialists at Farm Credit Mid-America are proficient and trained to use it. And again, we work hand in hand with our loan counterparts, Natasha, and our financial officers. And we're just really excited to get in front of you and use this tool to help you make the best decision for your operation. So what's next? We went through a tremendous amount of information today. Thank you for hanging in with us here at the end of the day. And we just want to leave you with a few action items, some very simple things that can be done in the next 45 days. As a reminder, Savannah mentioned your Farm Bill elections need to be elected by March 15th at the Farm Service Agency. Your crop insurance elections, by chance, do share that same date, but you've heard there are a lot of things to consider this year. So I would encourage you, don't wait until March 1st or March 5th. Start those conversations today. And, the best thing that we can do right now is start communicating with your agent, keep your financial officer updated as to your plan and your goals, and just know that we're here to help. So thank you for allowing us to be part of the event. And on behalf of Farm Credit, Savannah and I, we just wish you a safe and prosperous 2021. So thank you very much.
Thank you, Cody. Thank you, Savannah. Natasha, did you have anything else you wanted to say?
Thank you, Howard and Gary. What a wonderful seminar. Farm Credit's always thankful to be able to participate with our exceptional industry partners such as yourself. We know that as farmers, you, regardless of a good yield and increased profits, that you have a lot on your mind today, and whether that be the potential of rising interest rates, land values, succession planning, managing Farm Bill programs, and managing private products and Farm Bill crop insurance products. The decisions are endless and the hats that you wear are numerous. And all three of these businesses on the call today are here to support you. And I want to thank our partners for being industry leaders and thought leaders, not only for our own company, but our member owners across Indiana, Ohio, Kentucky, and Tennessee, and across the rest of the United States. So thank you, Howard, for allowing us to join you.
Well, thank you so much. I appreciate Savannah and Cody's comments, and always working with you, Natasha, is great. Questions? Anybody have any questions? I know I had some direct messages that I answered earlier, questions that came up about the value that a solar lease adds to the value of farmland. And I don't know if farm credit appraisers have seen any sales, but I don't know that we've seen any yet. Now, in my mind, it comes down to the capitalization rate. And if it's $1,000 an acre, because me, Natasha, I can only handle simple math. But if it was $1,000 an acre lease and you used a 5% cap rate, that's going to indicate a value of $20,000 an acre. I'm not saying that a solar field would sell for that, but you could impute that kind of value if you wanted a 5% yield. Obviously, most people are probably going to put that higher at 7, 8. If you go to 10%, then the value imputed by that would be more of a $10,000 an acre value. So that's where I've seen cell towers and wind turbines add additional value, and it's really capitalizing that additional income into the value of the land. So on an 80 or 120 acre parcel, maybe $600 to $800 an acre for a wind turbine, it might be a value that we see added. So had a question on carbon sequestration. That is a great point, and I forgot to mention that in my comments. Obviously, President Biden has talked about climate change and trying to really address that, and carbon credits is one of the initiatives he's been talking about. If they develop something, and I really hope it's more the carrot than the stick, but if they create a carbon marketplace that is valuable. Right now, I went out and looked, and there are probably 5 or 6. There was one magazine, I don't have it with me, at least 4 programs that would pay somewhere around $10 an acre, but it was a 10-year contract. So are you really going to do reduced tillage, no tillage, cover crops, and commit to that for 10 years for $10 an acre? I would say most producers probably would not. However, if that number becomes $50 an acre, would you? Because I would argue that there are some significant environmental effects that are positive to the farm if you do those things. So I think that's something to watch, that carbon market, and see what develops there. And does it become something that is more material than $10 an acre? And I'm not minimizing that. That is additional income, but there is documentation you have to do. You have to, sustain those, and sustainable programs. You have to keep them in place for that entire time period. And everybody knows that eventually you'll have a wet fall, or you'll have to harvest some things at times you don't want to, and then you want to do some tillage, and then you're locked into this contract. So those are some things to watch and see how that all evolves through USDA going forward. But that seems like one of those initiatives that probably gets addressed in the first 100 days to some degree, and before the next farm bill for sure. So that bears watching. Good question. Any other questions, Nolan, that you've seen come in?
No, I don't have anything.
All right. Well, hey, on behalf of Halderman, we do appreciate your interest in land, interest in farming, interest in obviously crop insurance, and then also wind and solar leasing. Trying to bring a few different topics to you this year. And it's always an ever evolving industry and a lot of different ways we could go with this. So I think we hit right at 100, Natasha, in attendance at one point today. And there was, Nolan said he saw somebody who might have had blowing palm trees in the back of their, now I don't know if that's a screen behind them, one of those setup deals, or if he legitimately was on the beach, but pretty impressive that we were reaching somebody on the beach today. That we're having more fun than maybe Nolan and I are down here in the basement in Wabash, Indiana. So anyway, we wish you the best this year. Have a great spring. Hopefully the weather is pretty decent the rest of the winter, and we get off to a great start this coming summer. Take a look at the commodity prices. They're really good right now. I would hate to pass at least some of that by without rewarding the market with some sales. That's just Howard's opinion. I am not an expert grain marketer. I'll readily admit that, but I do know profitable prices when I see them. So anyway, best wishes. Thank you for joining us today, and have a great rest of your week. Bye, everybody.